The cloud. All righty. Welcome everybody to our first of the February um Boston RIA meeting. I'm really excited to hear about this today because will be a new topic for me, and we've gotten lots of feedback that everybody's also very excited. So we will be doing questions at the end, but I do want to go through some announcements first and welcome everyone to the meeting. So hey, Sarah, how you doing?
Duncan, I'm good. Happy
Awesome.
February.
Happy February. All right.
Can you
So
believe almost through five?
we're going to Sarah, if you could also let people in as you see them come in, it'd be
Yes.
appreciated. All right, welcome everyone. Welcome members. And yes, you are in the right place for all your real estate investing needs, your pathway to success. If it's your first time here, thank you very much for joining us. I hope we can provide a lot of value for you. We certainly have a lot of membership benefits. So tonight will be speaking about hotel conversions, which I'm very excited about. Before we start, I do have to legally say this. This is a liability disclosure that Boston RIA, Real Estate Investors Association, assumes no liability or responsibility for the outcome of any real estate transaction, decision, or any action that any other Boston RIA member or visitor enters into a result of attending any meeting, listening to a guest speaker, or talking to any Boston member, guest, visitor, or person. So you are adults. There is no
Oh,
there we go.
Duncan.
No,
Okay.
I just said all that in one breath. So yes, here we go. Our
I muted you. I was letting
welcome
someone in on
everybody.
me.
Welcome everybody. So our liability disclosures up there. I just said it while I was on mute, but I'm sure you can read it. So there are really no do-overs in real estate. So please, just everything you hear and any person you speak to or any information you get into the chat while you're here, please do your due diligence on everyone. That's why I say we're here to facilitate transactions and education, but make your own decisions. Moving on. Okay. If you are part of us, you probably already know this, but if you're not, we are the most active real estate investing community in New England. We have a lot of deals going through our organization. We have a lot of networking and networking events. We always provide you with the new latest update in education and as an investor resource. If you want to know who is real estate friendly and who's doing deals and where you need to go, we're the place to come to. And you're going to hear a little bit about that later on. The Boston Real Estate Investors Association is a chapter member of the largest trade association in the United States. And we actually are the fifth largest trade association in the United States, and we're part of the National Real Estate Investors Association. So when you're a member with Boston RIA, you also get your National Real Estate Investors Association membership paid for by us. And we have some big vendors, big money lenders, and a whole bunch of programs that are going to benefit you in your real estate investing career. And you'll hear about a few later on tonight. I want to say that there is a chat box on the side, and this is your chance to network online. If you have something, want something, need something, please put it in the chat box. Don't write paragraphs, but a brief description of who you are, what you have, what you want, and your contact information, your name, email, telephone number. And before we leave the meeting tonight, just please copy and paste all that information into a notepad on your own PC, because even though I am recording the meeting, I am not going to be dishing out the networking information that was shared during the call. So that's one of the benefits of turning up live, that the chat box is there, and there'll be things that I'm sure will be very useful to you that will be distributed through that chat. So please use that chat. Just look down. You can right click it, and you'll see people already saying there. All right. So moving on from that, market update. Sarah, do you have a market update for us tonight? Do you want to speak a few words about what's going on?
Absolutely. Let me just very quickly share my screen, if that's
All right, I'll
okay.
stop my share. Yep, there you go.
Thanks. All right. All right. I think you can see my screen right now.
We can.
Yes. Okay. So market has been really, really fantastic. The past couple months, interest rates has been going beautifully down. And on average, what we're seeing is buyers are getting like about $40,000 in purchase power, on average, give or take, as you go in all the levels of purchase power. And this is a true reflection, like this is exactly what has been happening, even though like we keep an eye on other stuff like the stock market and all that. Um, really, really what's very important for me is that part, which is what's available in the market. Inventory continues to be a problem, even though it, as you can see, the difference, it's kind of like getting closer and closer to what it was last year, which is great. But again, inventory has been also low since last year. Like last year was also low. Contingent and under agreement, this is just in one day and only these three counties. So this is great to see versus what goes back on the market and what would have price changes. Price changes also to say, not only price drops, but also we see homes that do price increases. Those are not like a lot and they don't come often, but they do exist. And when you look for price changes, those will come as statistics as well. Um, what I like to see, what Sam Khater says. He's the chief economist of Freddie Mac, and I love to read always like what he says, to see what he thinks. But before we go on this part, rates continues to go down. This is a weekly thing that we monitor. Uh, they have been going down, not by a lot, but steadily down is good, even if it's just moving like 0.06 at a time is still, going in the right direction. Although affordability continues to impact home ownership, the combination of a solid economy, strong demographics, and lower mortgage rates are setting the stage for a more robust housing market. Mortgage rates have been stable for nearly 2 months, but with continued deceleration in inflation, rates are expected to decline further. The economy continues to outperform due to solid job and income growth, while household formation is increasing at rates above pre-pandemic levels. These favorable factors should provide strong fundamental support to the market in the months ahead. So, this is exactly what we're seeing. I mean, rates, pandemic rates is not going to happen anymore. But I mean, we're heading towards spring market very soon. I mean, it's February, very soon spring market will be here. So, and that's really when when people are more aggressively looking, buying and selling. And it will be very beautiful to that everything work together. Rates go down, more inventory and more buyers, come in. That will eventually will have more robust market. So that's what we're hoping for. With the job, stable, with the inflation going down. Again, inventory is the main really problem, but hopefully with everything working together, that we'll see more movement.
All right, so I guess a few questions there, Sarah, and also if you have a question that you'd like to ask Sarah, just write it down or put up your hand in the chat box. You can also use the reaction box down there if you have a question. So Sarah, you're seeing prices pretty much selling close to asking.
Actually, we have over asking. So this past weekend, I had two open houses. One was a multifamily at 850 price point, and one was a single family, 1,200 square feet at 450. It was like really like, like close to Worcester area. And they both got multiple offers and they both got over asking and they both were gone after the first open house.
Okay.
So, and they're both were very busy at the open house. So, and we're seeing again, it's not 30 offers, but 5, 6, 8, it's still decent, right?
Mhm.
Like honestly, if you get two, this is a competition right there.
Right. So are you still seeing a lot of people come to open houses? Is that the preferred method again to come to open houses?
They love open houses. Last
Mhm.
Sunday, that's when I did the smaller open house. The single family that was on Sunday. We had like really bad, like it was as the it was like snow, it was wet, it was slippery. The open house was just for an hour and a half, and it didn't stop. Like people came before the open house and stayed
Wow.
until after the open house. So I thought it would be like crickets, and it wasn't.
Wow.
So
And are you seeing people put in the offer the same day, waiting a day, cash offers more, finance? What's the sort of buyer makeup?
yes, no, people are aggressive and they submit offers like immediately. Like,
Mhm.
like, as soon as there is a chance to do an offer, like they submit it. Even when we say there is a deadline for offers, they still submit the offers anyways, regardless of the deadline. Cash
Mhm.
offers, absolutely. That single family, we had cash offers, and I believe the one that we accepted was a cash offer too, and it was over asking. So, yeah,
And
they are there.
are you still seeing closings 30 days? Are they extending out a little bit or no?
No, 30 days is what we're
Mhm.
seeing. So 30 days, a safe number that where everybody is doing right now.
Okay.
Um, During pandemic, it was like almost a race to quick closing. Like what had lenders do like 2 weeks.
Mhm.
3 weeks was a big hit, and then when the 2 weeks came, it was like a wow, it was like a cash offer basically. But no, I think everybody like is back to the normal. 30 days is a comfortable time
Okay.
frame.
So cash offers are still king?
Yes.
And then so the financing offers, are you getting any creative offers, or are you seeing people start to get credits to buy down the interest rate?
Not so many,
Okay.
to ask sellers to get like credit. I mean, people will do it, but I
Mhm.
mean, will they? I think what you're looking for is, are those offers getting accepted? I want to say
Right.
no, because it's not like when there is a competition, that's it. Like you really want to make the offer as sexy as possible. Otherwise, you just have no chance.
So I guess what I'm trying to get to illustrate to people is, um, as a real estate investor, have your money sources, your hard money, your somehow the money lined up, ready to go that you can make a cash offer to get it fast. And
Yep.
if you're a fix and flipper, you're going to have to find ways to improve value to get a higher price to make any profit. In the Boston market, I'm saying that's if you assume to stay there. Of course, you don't have to only invest in Boston, but we have to look at strategies, and hence one of the strategies we'll be talking again is a little bit different tonight than what's typical. Smaller competition. So, thank you very much, Sarah, for
Seriously.
that. And anything else you want to add before I take your
Nope.
screen away?
Nope.
All right, appreciate
All
it.
yours.
All
Thank
right,
you.
let's go back to the PowerPoint. Okay, now I just want to stress again that Sarah is our Boston RIA's investor-friendly realtor. So she will present all offers almost anywhere. She can get you set up on the system to get alerts and filter it down and keep you in the know and give you all sorts of good information. Sarah, do you want to say anything on that as a realtor?
Yes, so I am licensed in Mass and New Hampshire. Very experienced with investors. I work a lot with investors. In fact, those two open houses were for investors. And after they were completed, they got put them live right away. And so, you know, uh, I have no issues like with whatever offer that you want to submit, running numbers for you after repair value, getting the most money for it, even not putting a lowball offer for the sake of it. But I mean, it doesn't like I don't shy away from lowball offers, basically, is also
Awesome.
another thing. So yeah,
And that's across the board. Doesn't matter if it's a house, duplex, multifamily at all. So you'll take care of it all.
yep,
Awesome,
residential and
awesome.
commercial. Mhm.
So make yourself available. There's Sarah's email and phone number right there. Sarah,
I'll
if
put
you
them in
just
the
write
chat
that
as
in
well.
the chat too. Awesome. Thank you very much.
Great.
All right. So if you do want to be interested in meeting in person, we have once a month, the first Monday of every month from 6 to 8 p.m. At the beer hall. We kind of make it fun, have some activity, and it's pure networking, maybe a little bit of a chat for some vendors or, somebody that's there that's in the game, that wants to share some advice and stuff like Sarah's sharing now. But we meet down on the South Shore at the Stellwagen Beer Co. So it's 2 hours from 6 to 8. This one is $10, but you'll have a lot of fun there. So come on down and join us there. Again, that's the first Monday of the month. Move my screen here. So you'll see when you go to our website, our members area. Now, I just want to talk about membership very, very quickly and why it's so important to become a member of Boston RIA. Well, you can post your properties to thousands of investors. When you log into the members area, you'll see this on the left-hand side, and put your properties there and get it in front of other investors. So that's one reason. Just when you can have access to all of Boston RIA investors. And we're going to open up that to other investors across the country through our national RIA shortly. That's a great benefit to have. We also have the Homeworth National RIA Data Portal, and the membership fee you pay to us that we pay to National RIA gets you access to this data portal, map, and you can drill down very, very specifically, and it will tell you trends, conditions, insights that are going to support your investment decisions. You can zoom out, you can zoom down, you can look at high income households, turnover rates. You can find me a place, a lot of data in there, depending on how you want to do your data demographics and data drilling and all that. So you'll get access to that free. Usually other companies, if you're just paying for that service, you'll pay anywhere between $39 to $99 a month. So that's a good reason to do it. So when you log in, we also have our Life and Air section. So this is really how to not only become a real estate investor, but also, hey, about health, wealth, and life balance. And we have some great real estate education in there. So you just send an email to Boston RIA at Life and Air once you're in the back, and we'll get you going, setting up into our dashboard there, where you get access to that education and networking from that. One of the other things we have is our Rent Perfect investigative screening company. So this really, yeah, speaking from landlording in the old days to what it is now, it's night and day. So Renting Perfect starts at having a right process, the right screening, and the right service for people. So I just want to go through this. First of all, it's like you can sign up for 99 cents. Usually it's $39, but you get it for 99 cents here, and there'll be a link in the members area. But we take you through the rent process. You can do your online applications and tenant screenings, criminal background checks, credit score, evictions, judgments, and liens included in that background check, then per person for $44.95. Once you approve them, and now this backs into a detective who has a agency that goes and says, hey, look, this is really good, these are really bad. So they really give you a lot of insight, more than just an overview of the person. So that will get back to you, like within the next day. And then we have customizable on-lien leases, depending on what you want to do with that tenant. We have a move-in inspection process. We have offer renters insurance through that, and you can collect your rent through the online portal to you. And that's really a $395 cost per that, and $10 a month additional for that. So handling everything from this dashboard is really going to benefit your business. And with that, Rent Perfect also has a vendor VIP list. So if you want access to all our vendors, or if you'd like to be a vendor, or you're a wholesaler, you lend money, you're an attorney, please go and register for free on our list. Okay, because again, this will get your service in front of all our members. So you can once you get there, you can say, I need to download this list. And then if you're out and about and you have a call for a plumber, immediately it goes through a selection process of notify this guy to do the job. If you can't do it, it goes to the next one, and it's all done automatically online. So a great service that we provide for you. Again, this is free. Just log into the members area and look for vendor VIP. And like I said, if you got a service or something to offer, put it in there, register yourself so we can, other investors know what you're doing. So if you want to become a Boston RIA member, please text Kelly at 864-906-411, or you can go online but Kelly will do the application for it process for you right away within the next days. But we have so many benefits that you're getting discounts or free stuff that we offer you from if you're a rehabber, so that vacant property insurance, Office Max, up to 55% off discounts. You have your own business portal where 15% to 55% off pricing. You need signs. You have Rent Perfect. You have ways to contact your customer list. We provide you websites. We provide you leads. And one of the big things we offer is Home Depot. And just talk about Home Depot very briefly, is that our members get preferential pricing. So when you go in and you sign up into our pro loyalty program and you enter the Boston code, you will get massive discounts because we're the largest trade association. So if you're going to go and do any major shopping in Home Depot, once you've put that code in there, you simply go to the pro loyalty desk. They see your Boston REIA member, and they will give you preferred pricing on everything, mostly everything. You're like just getting involved in Boston REIA, you get 20% off paint right away. So that's huge. Plus, not only do you get the preferential pricing at the end of the year, actually every 6 months, twice a year, you get 2% cash back on all your spending. So there is a minimum there, but 2% cash back that comes to you either in a gift card or a check. So we have a lot of ways for you to benefit by joining the Boston REIA. So let us help you make money. Let us help you save money. So our yearly membership is $320. It's $320 per single, $450 for a couple. There is an application form Kelly's holding up there right now, and you can text her your email address, or she'll call you back and make sure she'll get that processed within the next 24 hours. And then after that, you'll get a welcome email, and then Sarah will give you a little call and just make sure you're registered right away to get your Home Depot benefits, because those benefits are phenomenal. And our average member in the last 6 months with their Home Depot spending got $1,500 back. Because you're in real estate, or even if you're doing your personal property, you want to make sure you get these discounts and the cash back. So it's huge, the benefits we offer. So I wanted to get right into the main meeting tonight, because I had a chance to meet Alex a few months ago, and Alex is the managing partner of Villicus Capital, and he manages the firm's strategy, market analysis, and underwriting. Now, he's an expert on a lot of topics. So we decided to pare it down for a topic tonight that I felt was very, very intriguing. I knew other people were doing it, and he says, you really got to be aware that this is a much bigger opportunity than you might think. So he's also the associate professor of economics and chair at the management department at Ferris State University. He teaches classes in managerial economics, economic growth and international business. Many peer-reviewed economic journals, law journals, national newspapers, and he's in multiple think tanks, and he does work with the congressional leaders in Peru too. So vast international experience. So let me bring him on right now. Alex, can you hear me? I know he's here. I
had to
see him
unmute
online.
myself. I'm
I
here.
had to unmute myself. All right. What I'm going to do is let me unshare my screen, and we can just talk that way. And did you have a presentation you wanted to bring to us, or just open up and talk about the opportunity?
I sure do.
Awesome.
Oh,
Oh,
in economics, we just love graphs. So I am not going to
I
miss
knew
an
it.
opportunity to share some graphs with folks. Yeah. It's well, thank you for having me, and it's a pleasure to be with you all. I see a couple familiar names, which is very cool, and I think I see the name of somebody who's done some hotel conversions, and
Wow.
so that's please chime in and augment where I've got gaps. And what a good group. I don't usually I have to like deduct points from my students to make sure that they're into class, but here we are on Thursday evening, and you all are ready to learn about economics, and I'm not even giving you a grade, which is pretty cool. So I'm going to talk about right now the economics of doing hotel to multifamily conversions. And before I do that, I am going to talk a little bit about the economic environment that we're in and why I'm going to talk about the economic environment that we're in, because I think that really sets the stage for why the hotel to multifamily conversion strategy makes sense right now. And this was not really a thing that, at least to my knowledge, as popular. I paid attention, and, and I will tell you how I got introduced and turned to the idea. And the way I'm going to structure my talk is I'm going to point out several things that I like about multifamily generally. And these are probably things that we all like about multifamily. And I'm going to go through and show you how all the things that you like about multifamily are probably better on a hotel conversion. And then I'll talk a little bit about a closing that we just had and show you a couple pictures of a project that is about to get underway. So I love this getting started. I love this quote from Napoleon, that the role of a leader is to define reality, not sugarcoat it, but also to give hope and to bring people up and not push them down. So here's the reality. Our economic environment right now is just extremely uncertain. And while all economic environments are fundamentally uncertain, the one we're in right now is uncertain for a couple unique ways, which I'll walk you through. And what that means is that we need a strategy, a real estate strategy that's aligned with the economic environment that we're in. And every good strategy has got to be aligned with your resources and capabilities. And I'm not here to convince you that hotel conversion is easy, but I don't think it is fundamentally more complex than maybe it sounds at first glance. And I think that it's just a tool in the toolkit that investors ought to be aware of, so that as you're out there looking at properties, you might find an opportunity where this suits your needs. So this is my favorite graph to show getting started, to think about the economic environment that we're in. This is a measure of the money supply, and you see that orange line represents what economists call M2, most common measure of the money supply. That's essentially cash and checkable deposits. And in 2008, all right, during the 2008 financial crisis, so '08 financial crisis into 2009, at that point in time, the Federal Reserve printed more money than ever before. And I want you to notice that spike in M2 that doesn't even show up on this graph. It's just absolutely a drop in the bucket compared to what happened in March 2020, where we went ahead and printed 40% of every dollar that was ever in existence. And it's just absolutely comical how the Federal Reserve turns around and says things like, this inflation is transitory, when we, in the summer of 22, we were having some of the highest inflation ever recorded in the last 40 years. And we hear it's transitory. And then we heard we're not even thinking about raising interest rates. And then we heard there's supply chain issues. It's the war in Ukraine, all these other. And do all those things contribute to inflation? Absolutely, but such a small bit. That 95% of all the inflation that we've experienced is because the money supply has been expanded by 40%. And then not only do they overprint, but then we turn back and over tighten. We've got the fastest increase in interest rates in modern history. Here's how that compares to how interest rates have been brought up after previous recessions. Look at the 22 to 23, just far outpacing the others. And that just slams the brakes on the economy. And thankfully, the Federal Reserve has kind of got what it wanted. We slammed the brakes on the race car, and thank goodness nothing broke almost 90% of economists at major banks this time last year were predicting a recession, and that recession did not come. That's to everyone's surprise. And I'm not saying that recession won't come. I do think it's pretty unlikely, but we're very lucky that we avoided it. They were late to the game in raising rates, and then they raised them too quickly, in my opinion, too far, too quickly. And now there's a lot of chatter in the room about rate cuts. I think that that's absolute fantasy. I think that we need to be happy that they're paused, and with inflation coming down, but still strong. I mean, it's still positive, right? It's not like prices have come down, and we've still got a lot of excess money out there in the system that needs to get soaked up. I really don't see the case for why rates are going to be cut this year. Now, let me be real specific on my language. Even if the Federal Reserve doesn't come out and cut rates, that doesn't mean that rates for investors won't go down. I think that rates for investors will go down a little bit. And that's because as banks observe the resiliency in the economy, in the labor market, and in the real estate market, and as demand for housing continues, which I believe it will because there's just such a shortage of housing, I think that the underwriting standards will loosen a little bit. I think that banks will be more willing to lend. And what that will translate into is moderate interest rate declines over what we're seeing right now. But when I say moderate interest rate declines, like that's like less than a point from where we are now. And I think that's what you plan for. Let me show you one more thing that we've got. And this is this is our job openings, and this is I need to get this is a couple days old, this chart, or I'm sorry, a couple months old. I mean, I should get an updated one, but but hasn't changed a whole lot. And what I want you to see is this is the number of job openings. So the exact number doesn't matter, but look at where we are in terms of job openings pre-COVID. All right, this is how many jobs are available in the economy. And pre-COVID, we had some of the lowest unemployment rates ever recorded in the country, and the lowest on record for certain minorities and other subgroups of the economy. And you fast forward to right now, we've got even more job openings than before. Why does that matter for real estate? Well, it's because wages are the biggest component of inflation. So when you've got lots of job openings like this and you got a really strong labor market, that means that workers really have the upper hand in demanding higher wages. And when they're demanding higher wages, it's tough for the Fed to get the inflation rate to come down. And as a matter of fact, if this number this number being so high, I think that tells the Fed this economy is so strong, it could sustain higher rates. We can go ahead and raise rates. Thank goodness we have seen, I mean, I'm sorry for that there aren't as many job opens. I don't want anyone to suffer, but thank goodness from a real estate investor's perspective, we've seen the number of job openings come down a little bit, because that's telling the Fed, hey, we got to really stop raising interest rates. We're starting to see the impacts in the unemployment rate. So to summarize a little bit here, here's where we are. We've got a very strong labor market, which puts the Fed in a tough position. They've printed more than 40% of every dollar that's been in existence since 2020. We spent a record amount of money on the fiscal side. The Congress spent a record amount of money. By the way, I don't know if you guys know, but and I say this as an economist, meaning just trying to explain the facts, not trying to tell you what's good and what's bad, right? That George W. Bush spent more money and added more to the debt than every single president before him combined. Obama spent more, added more to the federal debt than every single president before him combined, including Bush. The same is true for Trump, and the same will be true for Biden. The spending is just absolutely out of control, and we've hit new records during COVID, and you've got that in conjunction with the printing. And all of that money being spent and all of that money being printed just frustrates the price system. right? The prices aren't able to give us entrepreneur signals about the real growth and productivity that's happening in the economy. And hence, it's hard to know what will happen. And will there be a crash? When will it be? How severe will it be? What will change in the interim when you've got that kind of spending and you've got that kind of printing going on? So having said all that, that doesn't mean that we get upset or we go home and we cry. As active investors, we just think, how do we react to this? And let me throw you, and I think that hotel conversion is the way to react. Not the only way, but a great risk adjusted way to react. Let me talk about how multifamily was been performing, and this is no news to anybody, but I want to just put some data to probably some intuitions that everyone's already got. During the last decade, debt has been very cheap. Nobody really worried about interest rates. They were pretty low, and government spent like wildfire, and cap rates were falling. And that means that if you bought a property and cycled through multiple property managers, burned through more reserves than you planned for, overspent on your rehab, didn't had vacancies that were higher than projected, if you did essentially everything wrong, you had this tailwind of falling cap rates that essentially ensured that you made money, and everybody made money. The wind was at your back, so to speak. And that was true in essentially every market in the country, primary markets and secondary markets. Look at historically how cap rates have been falling. And by the way, these are apartment cap rates, multifamily cap rates. And for those that need a refresher, this is the cap rate you can think of as the multiple that is applied to every dollar of net income. So 1 divided by your cap rate is the multiple that's applied to a dollar of net income. So at a 10 cap, 1 divided by 0.1 is a multiple of 10. Right? At a 5 cap, then every dollar of income gets multiplied by 20. Just think about if your property over a decade, every dollar of income goes from being multiplied by 10 to being multiplied by 20. Even if your income stayed the same, your property went way up in value, right? It doubled in value. And that was the world that we lived in. At the same time, we have not really seen an expansion of real estate supply. Now, let me offer a caveat here. I'm talking about multifamily, and you see a lot of headlines right now, which are not inaccurate, about the record number of apartments that are coming online in major cities in 2024. And those are all projects that began when interest rates were very low that are now coming online. However, we have not been building at the pace to keep up with rental demand. And going forward, construction starts they're just anemic, and they continue to fall. Even in Q1 of 2023, when I don't believe, have to go back and look at the data, I don't think interest rates were quite at the level where they are now. Look at Fannie Mae and Freddie Mac volume down 36 and 60% respectively year over year. And multifamily starts were at a 39-month low. That stat is about 2 months old. A 39-month low. That's 42% down year on year. And I bet you that number is even lower now. So we've got a situation where we're not expanding the supply of housing, and it's still pretty expensive to build where the interest rates are. And of course, it's not like the regulatory environment, the zoning, et cetera, has gotten any easier. And at the same time, I don't think it's in the future that rates are going back to where they were. And I don't think that rates are really coming down that much at all. I don't see the case for cutting rates right now. So as active investors, one more kind of framing, a little more framing before we go into hotel conversion specifically. As active investors, I like to think about our fundamental goal as generating alpha. So maybe some folks have heard about this, but so what alpha is that percentage of return that you generate above some benchmark. So for example, if you bought a property and generated yourself a 12% cash on cash return in the year, it is not appropriate, in my opinion, to say that you have generated a 12% cash on cash return, because you have got to think about the opportunity cost of your dollars, where those dollars could have been invested in something that was totally hands-off or passive. Like, for example, the S&P 500. And if the S&P 500 returns 10%, you could have just put your money in the S&P 500 on E-Trade and gotten 10%, but you went out, you got off the couch, you went to Home Depot, you negotiated with the realtor, you dealt with the tenants, you found the property manager, you did everything that was needed to run a rental property, and you generated 12%, then we would say you generated 2 points of alpha, right? You generated, if the S&P 500 is your benchmark, you beat your benchmark by 2%. So every investor ought to pick out what their benchmark is. Maybe for some people, their benchmark is like the 10-year treasury. Maybe for some people, their benchmark is investing in some kind of a REIT or a syndication. And maybe for some people, it's the S&P 500. But your benchmark shouldn't be zero, because you can invest in other things that are a lot more hands-off than real estate. And so if we're not generating alpha, if we're not outperforming our benchmark, then we're wasting our time, right? We should let somebody else do our investing. So fundamentally, if I'm going to go and try and make any kind of investment on my own, like convert a hotel into multifamily, I want to make sure that I'm generating some true alpha over and above the S&P 500, or at some level, I'm not using my time very well. And that is a lot harder than you might think. For example, here, 84% of active managers, meaning people that manage money and they don't just buy and hold, they'll trade stocks on your behalf. Of those people, 84% of active managers underperform their benchmark, meaning they generated no alpha or negative alpha. And that number jumps to 90% after 10 years and 95% after 20 years, meaning essentially everybody that's trying to generate alpha in the public equities market, 95% of them don't do it on a 20-year basis. And you don't want to just beat the market and generate alpha for 1 year, 2 years. You want to do it consistently. Why am I telling this to you? Well, it's because when you think about a real estate strategy, we want to pick one where we feel confident we've got a chance at generating some outsized returns. We want to go for the gold. We want to go for the big kill. Otherwise, why not just put money in the stock market or let someone else invest your money in real estate? I'll switch now to telling you when I first heard about hotel conversion. I was at a conference. This was actually back in 2022, I think. It was just February 22. And I went to the Best Ever conference. Maybe you all have heard of it. Really, really good event. I'd recommend it. And I met there somebody that was from the same town where I live, Grand Rapids, Michigan. And he said to me, "Hey, why don't we go and look at this hotel that's for sale? I think it makes sense as a conversion." And I thought, conversion, like you're going to remodel every room? And he's like, "Yeah." And I thought, that sounds like, pardon my language, I was like, that sounds like a royal pain in the ass. You're going to add a kitchen to every room. You're going to somehow convince the city to change the zoning laws. You're going to maybe terminate the franchise on this hotel, take down all the hotel signs, get rid of all the staff. And then after multi-million-dollar construction, this was a big hotel, 150 units, you're going to then lease up all of those rooms. That sounds like a nightmare. That sounds difficult. That sounds like new development, practically redevelopment at some level. But he convinced me to come with him to see the hotel. I thought it was interesting. It was in my town. So I went, and it was an old hotel. I didn't really know what I was looking at. And then I went back and I was running some numbers on it. Running some numbers on the hotel, kind of running numbers through different different Excel like templates I had to analyze multifamily deals. And the template is producing these returns that are just unbelievable. And I couldn't believe how profitable this was. I stayed up almost half the night because I was convinced there was some error I was making, or there was some error in the Excel template somewhere. And then I just started working out the numbers by hand, and I came to understand that these problems that I just listed to you, finding the right building, maybe with the big room sizes, negotiating a zoning change, taking the franchise off, doing the remodel, then leasing it up. These problems, they're problems, but they're worth solving. And I realized that I was breaking one of my entrepreneurial rules, which is you just need to put a price on every problem. You don't need to say no to things until you've put a number on them. And just like we do with all kinds of investing, I'm sure there are a lot of people here that have bought an ugly house. And I'm sure you have a family member that was like, why are you buying that ugly house? This is what my mom would say to me when I was first started in real estate. And I was like, Mom, if I want to buy pretty stuff, then we'll go to Nordstrom to buy pretty stuff. Like, I'm buying profitable stuff. And that's the same story with hotel conversion. You want to learn how to put a price on all of these problems that you face before you say no to them. And so I started sitting down and putting prices on those problems. And I learned that you can buy older hotels that are not worth remodeling, where there's not a lot of demand. And for example, in the West Michigan market, and I can talk to you about some other markets, but just to give you a sense of what the numbers are like, $25,000 to $35,000 per, they call it in the hotel world, per key. In the multifamily world, we'd say per door, right? $25,000 to $35,000 per door, whereas a multifamily would trade or sell for $150,000 to $180,000 per door or per unit. And so you do the math on that. Is it worth putting up with getting the city to rezone you? Is it worth putting up with a $15,000 or $20,000 remodel per unit? Well, yeah, when we're talking about multiplying your investment that many times, it's worth figuring out. So I'll show you right now. I'll get into that in a little bit more detail. But what I want to do is show you 8 things that I like about multifamily. And I'm going to show you why I think that those 8 reasons why I like multifamily are even more compelling in the hotel conversion paradigm than in the traditional multifamily or apartment building paradigm. So here are the 8 reasons why I like multifamily. And I've got a feeling that folks on this call are familiar with them. There's growing demand for apartments. Household formation is growing. There's and at the same time, it's we've got high interest rates that prohibit people from buying homes earlier in life. And at the same time, they're not really expanding the supply of homes, and not at a very fast rate. There's opportunity to use creative financing to acquire properties and scale. The valuation is based on the cap rate. In other words, it's based on the performance of the property and not just beholden, or at least not completely beholden to the market. There's opportunities to get fixed rate long-term debt on multifamily. It's resilient to technology disruptors. Like, I can't imagine what Facebook or Amazon or Apple or Google is, et cetera. I can't imagine what those tech companies are going to create that destroys demand for a $1,200 one-bedroom apartment or an $800 one-bedroom apartment. Like, demand for an $800 to $1,200 run-of-the-mill apartment, there's going to be demand for that in every economic environment, in every town in America. And almost everybody needs something at that price point at some point in their lives. So it's resistant to technological disruptors, the business cycle. It pays you monthly. There's monthly cash flow. And there's real opportunity to improve people's lives by providing them a safe, clean, affordable place to live. So these are all great reasons to invest in multifamily. Let's talk about why each of these are better on the hotel side, starting with the growing demand. By the way, let me just a general note, and I'm going to throw out some predictions here. Economists don't like to be pinned down to predictions because it's just really hard. And so I would just say to you as a general um, not a disclaimer that these are only my opinions. I hope that's implicit. But also, I think as you're listening to people on like the CNBC or wherever, any kind of expert, if they're really confident in their prediction, like I would just be skeptical of them generally, because it is just fundamentally extremely hard to make predictions. There are just so many variables that are changing all the time. But I'm going to tell you some things that I'm comfortable predicting because I think that there's just so many macroeconomic forces that won't change that'll make these things continue to be true. And I think that we'll continue to have growing demand for apartments. Here's why. One, the construction costs of building homes has been rising, reducing building, and I don't think that will change. I don't think that building a home will require less red tape. I don't think that zoning laws will become less strenuous. I don't think the cost of labor will come down. And I'm skeptical that the cost of materials needed to build a home will also come down. The second thing is that household formation is increasing. Household formation is this idea that a household is formed when somebody needs an address. So you can think of it as when people move out from living with their parents, they move on their own, they need their address. So there's increased demand for household formation. This is kind of a multi-decade trend. And that's because people are leaving home earlier. But in addition to that, they're getting married later. And I've seen David Peters, who I think may be on the call, I saw somebody with that name, has put together a really great chart on the number of single person households, which is just shot up over the decades. And that's a big driver of household formation. And by the way, there are a lot. And then on top of that, there's growing demand because not just because we can't build more, but because, and every realtor on this call knows, people don't want to sell their homes right now when they're locked into a low interest rate. If they need to move, they're going to rent their home. We call those people the accidental landlords. And I've seen some math that about a 2-point change in the 30-year interest rate wipes out about 5 million households from being able to afford a $400,000 house. And of course, and that 2 points was going from like 4 to 6. So, and of course, 2 points higher than like a 6 to 8, I'm sure would wipe out a lot more than another 5 million. And then at the same time, all right, so we've got this growing demand for households, and some of my points here are about why supply is not going to expand as fast for that growing demand. But then we've got a lot of value add investors, probably everybody on this call, looking for the C-class apartment in the B-class neighborhood, or looking for the B-class apartment in the A-class that they can go in, spend some money on, and bump the rent. Well, I mean, that's a great business model, and that has been kind of the go-to for multifamily investors for the last 7 to 10 years. But guess what that does? That is shrinking the supply of what we might call affordable or workforce or like C-class housing, right? That's shrinking the amount of housing that is available for rent at the low price points. And actually, if anyone's interested, I'm glad to send you some articles, some really great data about how even if you look at all the building of apartments that we've done in the last 7 years, and we've built quite a bit of apartments, not enough to keep up with demand, but quite a bit. If you look at the number of apartments that rents for under $1,000 a month, that has gone down. That has gone down by, I can't remember the number of units, so I don't want to misquote it, but hundreds of thousands of units, if not more than a million units. That's gone down by. So the stuff that everyone's building right now, it's the B and A class stuff. Let me just show you some charts to back up what I'm saying. Here's household formation on the left. That's millions of households, and on the right, you can see the percent change. And notice maybe it's up and down a little bit, but it's always positive. We've got more than 1 million households being formed every year. Those folks need somewhere to live. And I'll send you these slides so you can go over them later, but I want to show you this stat here. I don't know if anyone is, you all have probably heard of this Joint Center for Housing Studies at Harvard. They put out a lot of really interesting research, and they got some high quality webinars. I would recommend you sign up for their mailing list. Lots of great stuff they put out all the time. But they put out some really compelling research on the statistics, the number of people that are what we would call cost burdened households. And that is people that are spending more than a third of their money on rent. And that is at a record high, a third of their income, rather, on rent. And that is at a record high right now. And then severely cost burdened people are people that are spending more than 50% of their income on rent. That is also at a record high. And the people spending more than a third of their income on rent was over 20 million households, not people, households, okay? So these are even people that have teamed up to live together and share the rent bill. Households, that's in 2021. That number of cost burdened people is up almost 3 million people just from 2019. And I don't think that they've released these numbers yet for the previous 12 months, but I have no doubt it's up even further. And so what does that mean? You got people giving a bigger percentage of their rent to their landlord, paying it than ever before. The wages are not keeping up with the rental costs. And my thesis there is it's because that economic, I don't want to say like low quality, but just basic workforce housing is evaporating. One more chart here. This is new housing. It says privately owned to separate from like government subsidized housing that is getting completed. The data is kind of choppy, just the way that this gets reported. It's seasonal. New units completed annually. And so notice, not only do we just really tank off in the number of units that is completed after COVID, but right now, if you look at this chart, right now we're building houses at the same rate that we were building them in 1995. Well, not only is the population a lot bigger than it was in 1995, but household formation, which is the big thing that drives housing demand, household formation is a lot stronger than it was in 1995. And by the way, you got to think about the stock of housing or the supply of housing. Oh, we got somebody that's got to mute themselves. There we go. Thank you. It's not like once you put a house on the market, it's kind of there for forever. Houses do deteriorate. They have to be remodeled, etc. So you do have to always be completing new housing, especially when you've got more demand for household formation. But we're just not, even though we're building, my point is we're not nearly catching up to demand, building at the same rate that we are in 1995. Now, here's what I think makes this really compelling. We're building at the same rate that we are in 1995, but it's not because we don't want to build. Let's look at how much money we're spending on building, right? Here's spending in the United States, just millions of dollars getting spent. That's at almost a record high. It's come down a little bit because of COVID, because those interest rates have come up, but we're spending more on houses than ever to get them built. And it's just too expensive. People need to rent, and they need to rent quality, clean, basic apartments. You all, I'm sure, especially the realtors here, have seen the historically low home inventory for sale. That's because those accidental landlords, they don't want to give up their low interest rate. I want to just one more thing, one more stat, and I'll talk about why a little more hotel conversion specifically. Here is housing completed that has 2 or more units. So you can think about this as multifamily that's getting completed. Now, some of it's small multifamily, some of it's larger multifamily, but look at the completions of two or more units, their average square foot of those units. It's falling, right? It's falling. Even where their builders are building stuff that is smaller. And here's my thesis for why the average sizes, the square foot of apartments, is getting smaller over time. And look, it's been getting smaller on average essentially every year since 2008. And that's because of, think of it this way. When you're building a apartment building, just imagine you're a developer, all right? Whether you're going to build an A-class building, a B-class building, or a C-class building, the person that's selling the dirt to you, I mean, the person selling the land to you, doesn't matter to them what kind of apartment you're building. They want the same amount for their dirt. And when you build an A-class, a B-class, or a C-class garden-style apartment building, it's pretty much the same roofing shingle that goes on it. You're building an A-class, a B-class, or a C-class building, you got to pay the plumber the same hourly rate to run the lines. You got to pay the electrician the same to wire up the building. You got to pay the tile guy more or less the same to put the tile in the kitchen, right? My point is, there are a lot of fixed costs to building. Hiring the plumber, hiring the electrician, framing in the building, buying the shingles, buying the land. That does not change if you're going to build the high-end A-class building or the basic C-class building. So if the plumber and electrician are charging more money, you're like, hey, I might as well go ahead and build the A or B class building. I got to pay the electrician $75 an hour to wire this thing up. And so I might as well go for the $1,500 rents versus the $1,100 rents. And the people that are building the C-class units, they're like, hey, if I have to pay the plumber $100 an hour to do the drain lines for my toilets, maybe I ought to think about making this a $1,500 a month apartment instead of an $1,100 a month apartment. The plumbing's going to cost the same. And so as those costs of things like plumbing and electrical labor and other trades, and also materials like shingles, toilets, etc., those materials and that labor that's the same throughout A, B, and C class apartments, as those things become more expensive, developers say, hey, let's just go ahead and switch over to B and A class. It actually doesn't cost us as much of a premium as it used to go to the B and A class. In other words, it's relatively cheaper. And at the same time, we got more millionaire renters than ever before. That's a lifestyle that some millennials want. They want to be mobile, and housing is less affordable than it's ever been. I mean, the number of renters, this did come out about a year ago. I should look and see if this has been updated, but the number of people that are earning $150,000 or more and are renting is now to over 2.5 million people. Why does this matter? All right. Why am I setting all this up? Because we want something that has growing demand. There's growing demand for apartments, but you know where there's really growing demand? C-class housing, because nobody's building it. The only thing they're building, if they're building at all, is the B and A class, right? And all these people that are buying the B class of property in the A class neighborhood and upgrading it, they're reducing the supply of the C class stuff. And as more people enter the rental market, either because they don't want to own a house, they don't want to be locked down somewhere, or because they can't afford to buy a house, more people crowding into the rental market, that means that those apartments are even less affordable. And the people that are renting the basic C-class apartments are squeezed even more, right? Enter hotel conversion, because what are we going to do? And we're gonna turn these hotels into workforce or things that are comparable to C-class apartments. I like to call this all these millionaire renters, or rather high income renters entering the rental market. I like to call that the crowding down effect. That puts, there's more, as high income earners go to the Class A buildings, the people that were in Class A are going to Class B. The people that were in the B class buildings are going to Class C, and the people that were in the C class buildings are getting squeezed out. And a lot of them are going to hotels anyway. And then I'll let you all read up on this on your own. I want to make sure I don't burn too much time so we get to Q&A, but there's a lot of cities are just unreasonable, to put it politely, on the types of zoning they'll allow. And they prioritize single family homes because that tends to attract higher earning households that pay more in taxes and want better public services and don't call the fire department and the ambulance and the police as often. And so a lot of municipalities don't want as much zoning for multifamily. There's a lot of, they call it NIMBYism, not in my backyardism, that is also restricting the supply of housing. Just real quick, do I think with all this fake money that has been printed, will single family home values collapse, even in the face of these high interest rates? Just want to show you two stats real quick. I don't think that they will, for two reasons. One, if you look at, the biggest one is actually we're just so undersupplied on housing that even really expensive houses, there's still plenty of demand for. But also, if you look at debt service payments as a percentage of people's disposable income, I understand this has gone up as interest rates have gone up, but it's just nowhere near what it was at the 2008 level where we had another housing bubble. People are not over leveraged in their houses like they were before. And to the extent that they are over leveraged, that is not as dangerous, because if you look at the equity levels that people have got built up in their homes right now, they're at essentially record high. So if they need to sell the home because they're in financial trouble, which, remember that strong labor market, I don't think they are, they would be able to cash out pretty quickly. Let's talk back to historical, insulated from technological change on the hotel conversion side. Hotel conversions have a moat. So if anyone's ever, I'm sure some people here have heard of Warren Buffett. And Warren Buffett says, I want to invest in businesses that have a moat around them, like metaphorically a moat, something that protects me or insulates me from competition. Most people generate a moat around their business by just having a differentiated product, right? Like Starbucks, it's a differentiated product. And maybe you get a patent on your differentiated product. That's the most common way to get a moat. Well, hotel conversions, I'd argue, have got a better moat around them. Usually our moat in real estate is our location. Hotel conversions have a great moat around them. They're usually in great locations, but also you're going to be able to buy hotels at a basis, at a cost basis that no multifamily person could ever touch. You can go to major cities in the Sun Belt and find hotels in the mid 30,000s per door and maybe even the mid 20,000s per door. Multifamily folks are never going to be able to compete with you. You can lower your rents way lower than they can and make money. You've got like a secret sauce to manufacturing or creating apartments cheaper than anyone else can. And when you're doing hotel conversions, that's a moat. That's a moat that's pretty much impossible to copy because they can't build units even that cheap. And then I think that on the hotel conversion side, there's even more opportunity to use creative financing. Here's why. Lots of, especially independent old motels, banks don't want a loan on them. And so that means that sellers are already predisposed to wanting to do seller finance, even second position seller finance. And then in addition to that, these things are easier, I think, to do creative finance because you can find lenders that will recognize that this motel, once converted on a per unit basis, might be worth 2 to 3 times as much as your acquisition price. And so they'll consider your loan to value based on the stabilized version of the asset. Let me just add some numbers to that. I want everyone to really appreciate this. So let's say you're buying a motel for $1 million. Well, you can go to a bridge lender and say to them, hey, once this thing is a stabilized multifamily, it's going to be worth 3 million. And I'm looking for a loan of 1.5 million to buy it and rehab it, in addition to maybe some other money you're bringing. And they'll say, oh, we're talking about a 50% loan to value. They'll use loan to value based on the stabilized multifamily value. And that can make acquiring the asset a lot easier. But the biggest benefit to hotel conversion is what I like to call the cap rate compression or the cap rate arbitrage. You're not just converting it physically. We're not just adding kitchens, taking down signage, and changing what the hotel physically looks and feels like. We're changing how that hotel is valued financially. It's a financial conversion. Most multifamilies, depending on the market, nationally, I would say cap rates are somewhere between 5 and 6 right now. So that means something between like a multiplier of like 16 to 20 for every dollar of net income. And then maybe for C class, you see cap rates 6 to up to 8%. So maybe a multiplier as low as 14. That's an 8 cap, a 14 multiplier, if I'm doing my mental math right. Well, a hotel usually trades for a cap rate that is in the low to mid teens, maybe even upper teens. I mean, imagine being able to buy a hotel at a 20 cap. That means you're paying 5 times the net income. And then once it gets rezoned as a multifamily and you lease it, the income is now multiplied by an 18 or a 20 and not a 5 or a 7. Even if your revenue goes down, the value of the property goes up because multifamily revenue gets such a high multiple placed on it. I was on the phone a couple weeks ago with a brokerage firm, a major brokerage firm. A friend of mine works there. They were asked to do a broker opinion of value on a hotel conversion, and they weren't really sure what to do with it. And so I got on the phone with them, and I was trying to help them out. And one of the guys, one of the financial analysts said to me, he said, I don't really understand why anyone would do hotel conversion. And I'm like, what do you mean? It's crazy profitable. And he's like, well, yeah, but when they take the hotel to an apartment building, it actually brings in less money. I'm like, yeah, I bet you that's true in almost every conversion, that the revenue or potential revenue as an apartment is lower than what it is as a hotel. But it doesn't matter because multifamily income is going to be multiplied by like 14 to 18, whereas hotel income is only going to get multiplied by like 5 to 7. You see, the valuation on multifamily income is much higher. And that's because multifamily income is considered a lot more durable, exactly because there's lots of demand for it and it's very hard to expand the supply of multifamily. So this is a financial conversion. Why is that important? Because cap rate compression means that there's not just big upside to doing the hotel conversion, there's also limited downside, right? Like when you're buying something for $25,000 to $35,000 a unit, you can afford to cut your rents to fill rooms in a way that the multifamily guy down the street cannot, right? And that means that even if interest rates were to pop or cap rates were to go up, you can still make money. You're still going to be able to get that building reappraised for likely more than you bought it for, or at least you've got a lot bigger margin of error than your multifamily guy does. Let's talk about long-term debt options and why those might be even better on a hotel conversion. So as we know in the multifamily space, Fannie Mae and Freddie Mac, they push out money to multifamily owners every year. They're under government mandate to do so, about $450 billion a year. There is no equivalent of money that gets pushed out to hotel owners. My thesis here is that motel conversion is actually better than multifamily. So think about this. Freddie Mac properties, those mortgage prices are the biggest part of that pricing matrix, as it's been explained to me, is based on an affordability score, right? Fannie and Freddie want to provide financing for affordable units. And there are absolutely C-class properties that get better debt terms than B-class properties because they get a better affordability score. And I've had mortgage brokers tell me that hotel conversions score so high in affordability that they're often able to get the best rates that Freddie Mac offers. So there may be better long-term debt on a hotel conversion. And I think you would have I think that there's a strong case to convince a local lender that, hey, nobody else is going to be able to provide this workforce, clean, affordable housing at the rate that we are, and we're going to continue to stay full. And then lastly, on the opportunity for monthly cash flow. Of course, just like with a regular apartment, there's monthly cash flow, people that pay every month. So also people that pay every week if you're running as an extended stay. And I would say that on the hotel conversion side, there's a lot of opportunity to include amenities into the rent and charge for them. Like on the property that we just closed on, we are not planning to sub-meter out the utilities. We're doing a package where everything's included right on down to the internet that we can charge for. We'll charge an amenity fee, which will add to our NOI, which of course then gets multiplied by the cap rate and increases our valuation even further. And you can do these kind of things on multifamily, but I think the demographic of the tenant that wants an $800 or $900 350 square foot studio, for them to be able to come in and everything is inclusive, right on down to the TV on their wall and the internet, the Wi-Fi that's in the air, that they'll pay a premium for that, to not have to go through and turn things on and give deposits and do a credit check, so forth and so on. And then lastly, I think with hotel conversion, there's an increased opportunity to better tenants' lives. So I teach economics, and I love teaching. My favorite class to teach is at Ferris. It's Econ 201, which is Principles of Micro. It's kind of like the first econ class that anyone takes. And I like teaching that because whenever I go somewhere and people ask me what I do and I say I'm an economics professor, their reaction is something like, ugh, I hated that class. It was my lowest grade in college. I got a C. I didn't learn anything. And my professor droned on about GDP and guns and butter, something like that. And I want to be their first taste of economics. And I want to teach them the economic way of thinking. And like selfishly, the reason why I want to do that is because I'm fired up to teach economics, to study economic growth, because I think that more economic growth will get you more of whatever you want in life, whether that's a material thing or it's just a longer life, more free time, more time with your family, whatever it is. Right? More economic growth, not that it's the only thing, but it can get us a lot of peace and prosperity. And I want students to understand how that market system works and how in this country, the rule of law and the market system that we have is pretty unique, and they struggle to get it off the ground in other places. And I worry that they're going to graduate, they're going to get their entry-level job paying $40,000 or $50,000 a year. They'll go and rent an apartment, and they'll have to give up a third of their rent for a basic apartment. And they'll say, shit, this capitalism stuff is stacked against me. This is going to be hard for me to get ahead. I am not in favor of this free market entrepreneurship kind of stuff. I like Bernie Sanders. And, selfishly, I don't want that. I'm sorry if that makes me sound like an ideologue. And I'm inspired by the idea of creating affordable housing that helps people get ahead and gives people a clean, safe place to live that we don't need to take taxpayer money in order to do. And I think that gives people opportunity, gives them more resources and peace to go and do whatever it is that they want to do in life, that not having to worry about spending 30 to 50% of your rent on month, 30, 50% of your income on rent will keep you burdened from. So in summary here, Here are my 8 reasons why I like multifamily. And in purple, and by the way, I'm happy to send these slides to everyone. In purple, here are the reasons why I think that hotel conversion is even better on all these 8 things. So while you're thinking up your questions, let me wrap up by showing you just some nitty gritty stuff, and I'll show you some property pictures. So like this, very tactically, practically, what am I looking for in a hotel to get converted? I'm looking for number one, extended stay hotels, right? Those are hotels that have already got kitchens in them, and there are when you get into looking at different hotels, you'll learn that when you take a franchise off a hotel, you usually have to pay a penalty. Those are called the liquidated damages. And so some liquidated damages are a lot higher than others. So for example, it's very expensive to remove a Hilton or a Marriott brand from a building, but Super 8, Motel 6, usually a lot more reasonable. So we're looking usually at these kind of 2-star economy grade extended stay hotels. We're usually looking for garden style, maybe a couple floors. More vertical buildings they can work, but they are more difficult to remodel typically. And I'm really looking for hotels that have a sub $50 ADR, or average daily rate, because to me, you've got an average daily rate under 50, you're starting to get in the death spiral. I call it the death spiral. And I learned that term from another gentleman that's done a lot of hotel conversions. The death spiral, where they lower the rate to try and get people in the door, but that attracts people that beat up the hotel, give the hotel a bad rap, maybe brings in crime, drugs, prostitution, and they've got to drop the price even more to bring more people in. They're not bringing in as much money. Ownership can't keep up with the repairs. They're in the death spiral. And they've got to keep those rates low because their property is beat up and in disrepair, and they need to offer a $40 a night room or even $30 a night room to bring anyone in. We're looking at hotels where we can renovate, adding kitchens and upgrading bathrooms for like $10,000 to $15,000 per room. I'm looking at markets where I can lease up 10 to 12 units a month. It's like a distressed hotel with a banquet center and 250 rooms. That's probably not a good conversion, just because all that common space, all the banquet space, usually can't be turned into units, and it's got to be climate controlled or at least maintained in some way. It can't always be monetized. And after you do a lot of construction, you need to get that thing leased so you can refinance. And so you really need to be able to lease minimum 8 to 12 units a month. And these are just rules of thumb, not like hard facts. I like to budget $4 to $5 a square foot for fire suppression. Those are the big things that we're looking for. If it doesn't have a kitchenette in it, I'm looking if it doesn't have sprinklers. And if it doesn't have sprinklers, they can be added. It's just cost money, right? It's just another problem we got to put a price on. Then it needs to have large rooms. Some combination of a hotel with large rooms. And so your standard hotel room is like 288 square feet when there. So I'm talking like over 300 square foot average per room. That's a large room to me, right? That's a larger above average room. So over 300 square foot on the rooms, preferably with the kitchenettes and fire suppression. Those are the big boxes that I want to check for a convert. If it doesn't have those things, that's fine, but ideally it's got those things. Otherwise, we got to really make sure it's worth paying to fix those problems. And I'll tell you what else is great about hotel conversion. In the multifamily world, it's like you get 30 days due diligence max. Maybe even you got to waive your inspection rights and, pay above asking price, on and on. No. Not in the hotel world. It's not a hot market for old distressed hotels. If you say I need a 120-day inspection period, a lot of times the seller will not even blink. That's very common in a hotel transaction. Usually when someone's buying a hotel, they might have to bring in a representative from the franchise, talk about what upgrades will be necessary in order to convert it to either a different brand or to bring it up to the latest amenities, etc. And that can take months to figure out. And you can ask for that time because you might need that time to go to your local government and take their temperature on the zoning change, moving it from hospitality zoning to multifamily residential zoning. And we can talk about that in the Q&A if you'd like. Some places are open to it. Some places, unfortunately, are not. And then kind of my other bare minimum is, and this is just a rule of thumb, I'm not real interested in places where I can't rent with utilities for $750 a unit. And I know in Boston, that probably sounds like a price of a cup of coffee to you, but there are definitely markets, right, in the Midwest and and even small markets in the Southeast where the rents are not even that high for studios. And those are not markets where things make sense. Just because when you're at a low price per unit like that, a low rental price, if somebody, let's say, breaks a window, breaks the toilet, punches the hole in the wall, when they do damage, that damage is a larger and larger that's a large percent of the income you're getting per month at those low prices, versus if a toilet breaks in $1,000 a month rental versus the toilet breaking in a $600 a month rental. You see, so at those low price points, the repair costs, your budget's very sensitive to those repair costs, knocking your plan off course. So here I want to just show everyone an example. Some of my partners are on the call, which is great in this deal that we just closed. I guess tomorrow's 2 weeks ago. Houston, Texas. And I'm glad to do a little Q&A about why I like Houston and some more of why I like this building. But this is a building built in 1985. And so it was kind of at the end of its economic life as a hotel. And at some point, like, it's just not remodeling this into the latest, greatest Marriott, right? Marriott will just build a new building. And so this property was built as a Holiday Inn, then it was a Best Western, then it was an Oyo, which is like the kiss of death in the hotel world. And then it was just a mom and pop, or unflagged. They call it, no franchise. And it was called America's Airport Inn and Suites. And this property is what we call mixed corridor. So you see in the back here where there's these exterior corridor rooms, and then the front building has got interior corridor, interior hallways. And that's just not really an architecture that they're remodeling anymore, right? That's not the style of hotel that people want. Most people want the interior corridor hotel, and they think of the exterior corridor as being more motel-like. And so we were able to secure this property for $28,000 a door. We were able to secure it with seller finance below prime. And this property, what I was drawn to particularly because it's 120 rooms, but it was built as 250 rooms. I'll show you a room picture here. And so at some point in time, what they did was combine all of the rooms, right? So every 2 rooms made 1. So you've got 2 almost 300 square foot rooms combined together. You've got almost 600 square foot units. So now we're really competing with 1 bedrooms, right? And where they had, once they combined the rooms, and so they've all got an adjoining door here, they took out one of the bathrooms and added a small kitchenette. Now there's a very small refrigerator and a small sink, and so we'll rip all that out to put in full-size appliances. But notice, and you'll once you start looking at these buildings, you'll get good at noticing. You see these little things up here? Those are sprinkler heads, right? So we had the fire suppression, we had the big rooms, we had the basics of the kitchenette set up, and we're really just coming in here and doing cosmetic changes. I mean, it's a lot of cosmetic changes, but they're fundamentally cosmetic. We'll be taking the popcorn off the ceiling, taking the wallpaper off, putting LVP down, new cabinets and appliances, new toilets and vanities, new light fixtures, all new plugs and switches. We got to add a couple circuits to each room because of to accommodate for the additional kitchen appliances, things of that nature. What do I look for in a market? And I would say this is one of the challenging things about hotel conversion is it's not like there's necessarily a ton of distressed hotels in your backyard. So you got to get good at analyzing different markets. You might you find the property first and then decide if it's in the market you like sometimes, versus in traditional multifamily, maybe you're a little more prone to say, I'm going to focus on this market and then find the apartment building I like. In the hotel world, like, or the hotel conversion world, just because there's fewer properties out there, it's a little bit of the reverse. So here's what I like in a market. Number one, got to have population growth. That's the number one. And that population growth has got to be driven by employment growth, right? Because those two things, that's fundamentally what drives household formation. And household formation is what drives rental demand. And then my other two criteria, I want an MSA population of at least 1 million people, and I want to be in a place that's on the upswing. We got rising home prices and rents. And usually that is because it's pretty rare to see falling rents and home prices where you've got job growth and population growth. Typically, these things are self-enforcing. But I'm looking for these 4 things with compelling reasons to believe that these 4 trends will continue. So now I've sung the praises of hotel conversion, but in wrapping up here, I do a disservice to you if I didn't tell you what the challenges are. And I would say that these are the 4 big challenges. The first one is some hotel conversion groups. There aren't that many out there, but some of them, I don't know that I want to say most, but a lot of them that I'm familiar with, they've got a model where they buy the hotel, they'll gut everything, and then start leasing from zero. And you can do that, but that is just really expensive, right? It's really expensive to carry the construction debt and take that cash flow and turn it all the way to zero. What I prefer is to remodel in phases. Like in our project, we're remodeling floor by floor. And as we finish remodeling, we'll start leasing. Even if we have to start doing weekly leasing before we go over to full multifamily certificate of occupancy. And then we'll try to keep as many hotel rooms occupied on a weekly basis as we can. And so like right now in that hotel that I just showed you, we've got more than 60 rooms occupied. Almost all of them are filled with people that have been there longer than 4 months. They're already effectively using them as apartments. And we'll try to keep that occupancy there. That really cuts down on the amount of cash that you burn when you're doing the remodel and the stabilization of the property. However, that's management intensive. You got to have a multifamily manager, and then you got to have someone that can do the hotel management. It's a different skill set. Most apartment folks are worried about doing hotel management and vice versa. So you've got to be a little more hands-on in the management. Then you call an insurance company and you're like, we need insurance. And they're like, wait a minute, is it a hotel? Is it an apartment? What is it? And so I don't know what your experience has been with insurance people, but it's probably a lot like mine, which is you better be a square peg and we better have a square hole to put you right into, or we don't want to write you insurance, right? So when I first started doing this, it took time to find the right insurance contacts and lenders that understood the model and were willing to play ball. Another challenge is getting clear answers on what your property taxes are going to be. Because maybe you buy a property and now you're going to essentially maybe triple the value of it. What are they going to do? But you might not sell it. Exactly where are they going to reassess you? Does the municipality treat taxes for multifamily differently than hospitality? And surprisingly, it can be hard to get clear answers on. And that's actually a downside to investing in Texas is what's called a non-disclosure state. So you actually don't have to tell the local government how much you paid for a property. And that means when they're trying to decide how much to charge you in taxes, they assess it on their own and you might have to fight with them. And that means that once they see you've bought something and took it to a hotel, exactly where are they going to make your taxes? Well, it's a bit of a black box. I mean, there's some things you can do to research it and hire consultants, et cetera, but it's less straightforward than with multifamily. And then I would say the last hard thing is if you're trying to get an investor or convince your friends or your partner to do it with you, and they're like, what you want to do all of this complicated stuff? Like, let's just buy an apartment building, right? It's a long It's a complex acquisition, right? It's a lot more of a complex business plan. I think those complexities are worth it, right? I think that risk adjusted, those returns are worth it, but the sales pitch is longer and more complex to investors and lenders, etc. However, just a quote from, this is the book I most recommend to students. I just cannot recommend it highly enough. By the way, I think about books as like they have to be the best investment on the planet. They have to be. Like this book, look at this. Used on Amazon, it's $2.93. Like your ROI off of just reading half of this book must be thousands of percent. Like you should just, I tell all my students, you should just have a budget minimum that you spend every month on books, because the ROI is so high. Even if you buy them and you read half of it, or you don't read it, or you give it away, like the ROI is just so high. You can't not be buying used books on Amazon. So I love this book range for a lot of reasons I won't get into. I wish that I wrote it, but kind of the thesis of the book is that people that are really creative and successful don't follow the Tiger Woods 10,000 hours rule. So like Tiger Woods' dad thought that he was really good at golf because as a little kid, he did it for 10,000 hours. And this author sets out to research, is this rule that you do something for 10,000 hours and you get good at it, is there research behind that? And does that make sense? And the thesis and the argument of this book is no. And he says that when you do something for 10,000 hours, you get good at it if it's got three characteristics. If you're playing golf or chess, and in other words, an environment that's got stable rules, instant feedback, and accurate feedback. But if you're in an environment where the rules are changing, the feedback is not accurate, and the feedback is not instant or inconsistent, then 10,000 hours of practice doesn't help you. And you know what has not, what's got changing rules, feedback that's not accurate, and feedback that's inconsistent? The business world, right? The economy. And he goes on, the book points out that people that have range, in other words, people that have studied many different topics and are able to pull from knowledge of many different kinds and many different experiences in life, those are the people that are the big innovators and the people that are really able to succeed in different environments. And by the way, I'm really partial to it because he has a lot of data on how economics students score the highest on a lot of critical thinking tests, because they have range. We teach them the economic way of thinking, teach them tools that can be broadly applied. And so you can take your multifamily tools and apply them to hotel conversion. And one of my favorite parts of the book is where he tells a story about a firefighters that go fight wildfires. And they've got these real heavy tanks of oxygen that they wear like backpacks. And the firefighters are trained to take the oxygen off when it runs out because the tanks are really heavy. Like, take it off and try and get out. Don't try and escape the fire with the tanks on, okay? And they find these firefighters often perished, dead, with the tanks on them still, even though they weren't trained to. And the author talks about how these guys are just like psychologically, they're clinging to those tanks of oxygen because it gave them life. And they're clinging to them even though those tanks have stopped serving them. And he uses that as a metaphor for how sometimes you gotta let go of what's familiar, and that just because something is familiar doesn't mean that it's safe. And people that have range have really learned to appreciate that. And I think that's the same for hotel conversion, right? We're in a new economic environment. We're in a new world of real estate with all this printed money and the shortage of housing and this non-expanding supply of new building. And I think that just because something is new and unfamiliar, maybe it's less traditional to convert apartments to hotels, that doesn't mean that it's not something that's worth considering. And by the way, people have been converting old buildings to different uses. You look at any 200-year-old building in downtown Metro, I'm sure it's been converted to different uses over the years. So now we've defined reality. I've told you my strategy, and I hope that that makes you more aware of the risks out there. And I hope that you go forth and think about how you can generate alpha in your investing business using some of the things that I've shared. Welcome to email me anytime. It's my first last name at villicus.capital. Villicus is Latin for steward. And as an academic, I'm partial to the Latin names. So even though people are not sure how to pronounce it, I appreciate that it was pronounced properly in the introduction. Yeah, it's still the brand name. So I'm sure, or I hope we've got some questions. I'll stop
Yeah,
there.
Alex, thank you, man. I am truly amazed. I had never really thought of this, and I guess well, I shouldn't say never thought of it. I just kind of like gaffed it off, I guess, like you did in the beginning, thinking, why? Everybody, you think hotels would make more revenue, but I never knew that about. So yeah, it makes perfect sense. So in the process, I think you said the main thing is you just got to be really good at analyzing deals, finding these type of leads. Yeah, I totally agree with you. Everybody's trying to get the C class and B class neighborhood, the B and the A, and you just go through hundreds of these things. So you had to instantly learn to analyze. But yeah, after 10, 15 years of people learning that strategy, it's hard to get into that. It's gone. Not saying it's gone, but it's very
It's just more
difficult.
competitive, right?
Yeah,
It's a saturated strategy. Find the B
yeah,
and upgrade. And if you can find it, like I would do it. It's a great strategy. It's just tough.
it's very tough. So yeah, I think the areas you got to look at it. You could do this really anywhere. You're just looking for, like I said, the garden style apartments. And you know what? I look around as I've taken road trips. Like, yeah, there are plenty of these type under $50 hotels you can run into.
There are,
Not
because like 20, 30 years ago, it was not considered dangerous or weird to stay at them. But
right.
families are not stopping and staying at those old mom and pop roadside hotels anymore. Like brands like Marriott and Hilton have come out with more economy brands. People are going to your VRBOs and Airbnbs, and these properties have become deflagged. The franchise is gone, but they're still there existing. They're just full of transients.
Yeah, and that's the scary thing. So I can see it. It's become more of a job to run these. Not, I guess down in Florida, we're seeing people just tear the damn things down now. But then you get your new building costs. So when you do your financing on this, I can imagine though that the building cost is cheaper than building new. You don't usually put more space into it, build out the property, or you just keep the amount of rooms that you have in it.
That is a great question. Do we put more rooms in the property? So when in every hotel that or almost every hotel that I've toured, I've found hidden rooms in the property, because
Mhm.
hotels have got great big laundry rooms for commercial laundry equipment and storage areas and meeting rooms and banquet space, right? And a lot of that can be converted to units. And however, in terms of like space to expand the building, I'm not a developer, a builder, so I'm not super fluent on that stuff. But one of the big constraints when you're looking at a property is making sure that it has enough parking. So most cities, and again, this depends on the city, they're requiring like a 1.2 to 1.25 maybe parking ratio, which means 1.25 parking spaces, 25% more parking spaces than your units. And that's pretty par for the course on a multifamily deal. But most hotels are not designed to run at 100% occupancy every night,
Right.
and they're in a little bit more dense area. So it is not uncommon to see a hotel that's got a 1-to-1 parking ratio, one space per room.
Mhm.
And if we're in that scenario, if there's any extra room on the property, the first thing is we're probably looking at using that extra space to expand the parking and adding more units. It's just not that I wouldn't do it or it doesn't make sense. That's not a situation I've really encountered very often, a situation where that really works.
Okay. So I had one question here about, is there any time in the future you could do like the back to a condo conversion and resell
Yeah.
one or two of them?
Okay. So that I have a lot of people ask me about that. And I know that you're like you guys being in Boston or folks that are in California, I'm sure like very high prices and there's like there are a lot of condos for sale. And so you think, aren't these things worth more as condos? Perhaps they are. I'm just not an expert in that. And the markets where I'm shopping in, more like the Midwest and the Sun Belt generally, those are not markets where there's a strong condo market. So I'm not even thinking about condo conversion. I just don't know if that would work. But I think that in a really high price coastal market, just intuitively it makes sense to me. And I don't know them personally, but like I know of other people that have done condo conversion out of hotel, and so I'm assuming it's profitable. It seems like it would be, but
Okay.
not in the
So
market we're playing in.
because you're changing it into multifamily and you're having these, I'm going to assume smaller square foot units. Does that mean you start adding in amenities such as like, you're doing the Wi-Fi around the courtyard, working areas for coworkers and that sort of stuff? Are you hitting
That's
that
right.
demographic or?
Yeah, that's exactly right. So it depends. So like just in generally, what you're saying is absolutely right. If you've got a fundamentally smaller unit, you got to plan on the fact that people are going to spend a lot of time out of the unit, meaning that you want to have high quality common space, right? And this depends on the demographic where you are. And like I've looked at some neighborhoods where it was clear that you were going to have a lot of young folks in their mid to late 20s living in the units. Where that property I just showed you that is in Houston, it's only like 4 miles from the airport. It's around a lot of warehouses, a lot of like blue collar warehouse workers and retail workers there. I don't know that the common space is as important to them, but we got a lot of common space that like we want to remodel and we want to make it nice. And to the extent that we can turn some of the space into areas for resident storage, I think that that's going to be very popular. We're actually looking to, there's part of the banquet space in that hotel. We're going to chop up and make into 6 additional rooms.
Okay, so in this multifamily community, you would see not having restaurants and a coffee shop and that sort of amenities to bring in there unless it's in a, I guess you found a C and an A sort of area, sort of thing.
Exactly. And I think that beyond that, I don't know that I'm always thinking about the the cap rate compression, right? Like I want to get multifamily income because that's where I'm going to get the 14 to 16 multiple. And so if I'm income from a bagel store or a convenience store or a coffee shop, I'm not going to get that. I'm not going to get that kind of rent premium on that kind of amenity. And I don't know that the folks that are looking for an $800, $850 to $925 a month, workforce affordable apartment really care about whether or not they could buy a coffee in their floor,
Gotcha.
right?
Yeah,
My
that makes
sense
sense.
is those guys just don't care. This is not to say that you can buy in a crappy location. Like ideally, you want to be walking distance to a grocery store and you want to have stuff nearby that is a signal that that these tenants can walk somewhere. Not all of them will have a car,
Right.
but yeah, like retail on the first floor, other kind of higher end building amenities, we're not thinking about. Like in this remodel, for example, this might shock some of you. We're not doing dishwashers. We may do dishwashers in some unit, but we're certainly not doing them in every unit. And where there won't be garbage disposals. There likely will not be solid surface countertop, right? It's going to be more there's probably going to be rubber baseboard, right? It's this is where our big competitive advantage is the price. We're going to be the only place where you can move in all included down to the Wi-Fi, and it's $900 a month.
Okay. So would you see these being merely at most for two people, a couple, younger couple or an older couple, than trying to cram a small family in there?
That's right. That's right.
Okay. Which, like I said, they want to be more mobile. So are you going, and I like the idea in the very beginning, as you're turning these things over, you do a short-term rental, which is great. Which I guess, I mean, you could keep a couple for short-term rentals if need be, but you're figure.
Yeah, so that brings up another question. Like, what do you want to keep some as short-term rentals? I mean, it is a hotel, so it's not like you can, you've got kind of the infrastructure, the setup to maybe set aside a wing, put them on Airbnb. That really just depends on the market. So, like where we are in Houston and that property, it's a competitive hotel market because it's by this big international airport. So there's a lot of other hotels nearby, but so I don't know that long term we want to have a big short-term rental plan for big short-term rental income off that property. But the other thing is, when you're going to get multifamily debt and multifamily valuation on your income, most lenders don't want to see more than 10% of the units allocated to short term. Right.
I understand that. Makes sense.
We want to make sure we got leases. And again, is that going to be less revenue, right? Absolutely. But we're going to get the big multiple on that revenue.
Which makes perfect sense. So do you, when you're talking about leases, are you talking a minimum term of 6 months, a year, or what do you need to do to get that multiple? Is it different?
Yeah. So we're going to have to defer to a mortgage broker for precise on that. I mean, I don't know if you signed for a year and then somebody went month to month, that they would start dinging you. I think usually when you're doing a refinance on a new development, most lenders want to see, they call it the 90 for 90. So they want to see that you're able to maintain that 90% occupancy for 90 days. And the better the history of occupancy, right? That's really what they care about versus how many months do people have left on their lease. And now when we're leasing up, like we'll do some 12-month and we'll do some 6-month, right? Because we don't want everything to expire all at the same time.
That makes sense. Yeah.
Right. And we'll also test the market for, can we get a little bit of a premium for a 3-month or a 6-month, right? Versus the 12-month.
Okay. Thomas had his hand up. I'm going to ask him to unmute to ask you a question. Thomas, take it away. Just unmute yourself. Is he there, Thomas?
Where'd you go?
Yeah, I'm here.
All right.
My computer doesn't have any camera or voicemail, so I'm doing a combo of the computer and the cell phone.
Wow.
Okay, I guess that's why we're getting a little bit of
Feedback.
Feedback.
Yeah,
there.
I'm going into another room. Okay.
Okay, super.
Now, I was thinking about, if you mentioned like the restaurant space, stuff like that. Where I live, we have a gym built in, and that's one of the assets that is one of the rental selling points of the facility. So the people have their own built-in gym.
Yeah. So on that point, actually one of my partners, Jeff, is here on this call. And I remember we were walking through a hotel that it had just been remodeled to an extended stay. And we were considering purchasing it before they put the franchise on the building. And so they had a room remodeled for a gym, but they did not have any equipment in it. And we were walking through that building with a potential property manager. And I asked her, do you think we need a gym? And she says, in all of our C-class buildings, like just nobody ever uses it. Maybe you have to put a few things in there so you can check the box and they feel like you're giving them amenities on par with everyone else. But like these people are working all the time and they're just, I'm not trying to be rude or judgmental, but like they're just not prioritizing going to the gym. So like the property we just purchased, it has a gym, there's some equipment in there, and it's TBD exactly what we do. But my sense is that at this price point for this tenant profile, that's just not important to them. I mean, that's, you know, I would love to. I wish I had a gym in my house, and I loved living in a multifamily that had a gym in it. But these people are really price sensitive. Like, think about like you're working at the airport. When I was at the hotel the other day, I'm in the elevator with people that had like their TSA shirt on, or their budget or the Avis rental car, you know, employee shirt on, and they're making like 30 grand a year. Like, when you're making 3 grand a month, right, pre-taxes, the difference between a $1,100-$1,200 a month apartment and like an $850 a month apartment, that's huge savings to you, right? To the point where if you have to get a $10 Planet Fitness membership, like, you're cool with it, because there's so much saving on the rental.
Oh, thank you, Thomas. So let's talk about financing. How does this traditionally work in finance? Is there banks out there, or is it something you need private lenders for, or is there a fund that people can go to? Is it hands-on, hands-off? Explain how you see that.
Yeah. So that is definitely a difficult part, right? Because just imagine a traditional. So there's a couple ways, but like, that was definitely hard when I first started trying to do these deals. And there's a steep learning curve, and it's not like there were a lot of places you could go, or folks you could call, just because there's not a lot of people that have done it in general. But that'll change as more and more people do it. And just imagine going to a lender and saying, yeah, I want to buy this thing and turn the income all the way to zero. That makes the lender real happy, right? So there are lenders out there that are increasingly aware of hotel conversion and understand it and understand the potential. And so it's catching on. And so I would say that your best bet is with a local bank that knows the neighborhood and the area, and maybe even knows the asset. And as a matter of fact, I got an email today from a lender that is the current lender on a hotel we are considering making an offer on. And that lender's like, yeah, we would do a new mortgage on that asset. We're familiar with it for this conversion play. So you would go that route, or there are bridge lenders that specialize in hotel conversion acquisitions, and they'll do like 12, 18 months, etc., of bridge debt to allow you to acquire, do the construction, and then once you've got some rental income, you refinance into permanent multifamily debt. And just some names, Peachtree Capital is a group out of Atlanta that does it. Tioga Capital, TIOGA. Those are people I've gotten term sheets for, and I can think of some others. Monolith Capital, MONOLITH Capital, got term sheets from them. So there are bridge lenders out there that will loan on this kind of thing, and a good mortgage broker can help you find these people.
Awesome. So for the beginners, is this something that they should look at, that they could get into syndicating a deal, or just, what sort of expertise do they need?
It really depends on the deal. So I would say that if you're gonna syndicate it, right, you make sure that it's with other people that really understand the business model well, and they're people that you trust. Because when you're doing a big reno, I'm sure everybody on here knows, when you're doing reno, there's bumps in the road, and these things come with a lot of reno. So you make sure that when you're syndicating, you got fat reserves, and that you're working with people that you can trust to get over those bumps in the road. But I would say that for beginners, if you can make sure that you get the zoning part figured out pre-closing, and you're talking about a hotel that has got fire suppression, and maybe it's got kitchenettes in half the rooms, not that complicated. And by the way, there are a lot of mom and pop hotels out there with like 25 rooms, and nobody is buying those, right? No bank wants to lend on them. You can probably get very favorable seller financing terms. I mean, it's not like the construction is fundamentally different. Bathrooms are bathrooms, right? Flooring is flooring. And so I would say, if you are familiar with construction and you've done some flips, etc., and you found that a small hotel motel in your local market, I would think that, with the right due diligence and the right research, a beginner with the right work ethic could do it.
Awesome. Awesome. Well, Alex, I am
I see
very.
Kelly's got her hand up.
I
Hello.
do.
Okay.
This is Alex, great information. I can see how this would add value to an investor's portfolio for sure. Two questions. First part is, do you ever partner with investors? And the other one is, sometime as far as demographics go, have you ever done like a 55 and up where it's just a senior facility kind of situation?
Yeah, that is such an interesting question. And I actually met with last month a gentleman who his family is one of the a top 10 owner of 55 up facilities and nursing homes nationwide. And he is really interested in finding 55 up facilities that could be converted to multifamily. And I toured a 55 up facility for the first time that was for sale this week. And so I've not done one of those. I haven't researched it that much, but there is a lot of potential there because, just real quick, remember I said that a big thing you're looking for in the hotel is, does it have sprinklers? Because the city's probably going to make you add them. Well, the 55 up facilities, like especially if it was a nursing home, was built to a lot stricter building code, right? Even 30, 40, 50 years ago. And so we went in this 55 up nursing home that, I guess that's different than a 55 up community. It's an actual nursing home, but sprinklers in every room and the hallways. And the most expensive part actually of our current Texas project is the new electrical that goes in each room. And that requires skilled labor, and there's a lot of copper. Whereas in the nursing home, there were tons of circuits in every room because every room is set up to have so much equipment in it, right? There's plugs and circuits everywhere. Now, what was the downside? There were not showers in every bathroom. Every room had a bathroom, but did not have showers. So that presented its own challenges. And I don't quite have a construction bid on that or know exactly how to handle it. I know some buildings will have floor drains and some will not. To your other point, though, about what about just converting a hotel for 55 plus? I've not done that. And I think it just requires the right local knowledge of that market. Like if there's a real gap for that in that market, again, I don't know a lot about this, but I'm just thinking if you've got the kitchen space and then you've got the rooms, like where's somewhere where the 55 plus folks can live and essentially like their whole social security check will allow them to live in the hotel. And, maybe there's some meals or food service available in the property also. Like I haven't researched that deeply, but intuitively that does make a lot of sense to me.
I asked that in part because I just turned 56.
Oh, wow. I would have never guessed.
So, so there's that.
Yeah. And to your other question, we absolutely partner with good people. And the last one that we did was a small syndication. And sometimes we do that. I'm proud to say that on the syndication side, we don't charge the crap junk fees like a lot. I saw this. I mean, I was looking at this. I don't want to call anybody out like by name, but I was looking at somebody's pitch deck the other day, and it was like the two GPs were collecting like $500,000 in fees at closing, and it's like, guys, are you in the real estate business or the fee business? Because it's like you make more money off the fees than the real estate. And so we don't have any acquisition fee, disposition fee, on and on and on. And so and also in this last one, we didn't do a waterfall. I don't know how familiar you are with that in the syndication world where the profit split changes over a certain threshold, but we didn't do a waterfall. And that's just because on these deals, there's a lot of meat on the bone. and it's because like this is a new paradigm, and so people that are investing with us on this project, like they're taking a risk on going in on a wholly new type of paradigm, right? So I want to compensate them for that, and I want to retain them so I don't have to go out and find 500 different people for the next 10 projects.
Thank you for that.
It looks like, if you don't mind, it looks like my partner, Jeff, what do you want to say? Or he wants to chime in.
First of all, Alex, it's been really wonderful working with you. I do need to give a shout out to the person who really introduced me to hotels and conversions and so forth. And he's a lawyer, but he's not my lawyer. And his name is Charlie Dobbins, and he's a Boston guy. And he's really just, I've learned so much from him about multifamilies and hotels, and Dave Peters, who might be on this call, and so forth. So really, I owe them quite a bit of, especially Charlie, quite a bit of gratitude. I learned so much from him.
Us here at Boston RIA, we all know Charles Dobbins very well, don't we, Duncan?
Okay, so Charlie is he's probably one of the brightest guys I know. I've learned so much from him.
He's hosted with us many, many times.
Okay, so
And the funniest.
Yeah, yeah. Right, Duncan?
Yeah.
He's funny.
All right. So, Alex, do you just want to give him your information in the chat one more time? I think we're all right now on time. So guys, I urge you to, reach out to Alex if you have any more questions. This is not an area of my expertise. I'm just excited to hear about it tonight. I learned a whole lot of good stuff. You gave me, I think everyone said, who's logged off so far, great content, and thank you very much. You mentioned that there's a couple other subjects you can talk to us later on in the year about. So we'll be anxious to hear about that, about what else you have, and made me like economics again.
Yeah, anything economics, I'm glad to talk about. I'll also put the link to my.
How do so many economists get it wrong?
It's that hard. I don't know. Or maybe I don't know. They didn't learn from the right people.
I just don't know who to believe sometimes. In the same day, you can hear two economists say the different things. I'm like, what? I don't get it.
I understand. Yeah, I understand. Mm-hmm.
All righty, everyone. Well, it's 9:00, and I promised you 2 hours and a lot of great content. So be sure to copy the chat. You got Alex's information, and we're glad to have you back and very excited. And thank you very much, Alex. Appreciate it.
Yeah, thank you all. It was a great time. Good to see you all.
That was super cool. Really interesting.
All righty. Take care, everyone.
Bye, everyone.
Bye-bye.
Thanks, Alex. Thanks, Jeff.
Thank you.
Thanks all for showing up.
Okay, I'm clicking off. Last chance to grab that chat. Just copy and paste the whole thing. You see Alex's LinkedIn profile there, and you have his information. And if you wanted to hear it again, I will be publishing it as a replay on our member site, and I will send out an email when that is done. So thank you all. Have a good evening.
Bye, everyone.